Just won on Wednesday, December 11, 2013. Obviously an uptick in selling today, and I think it's important and helpful to return to this S&P 500 index daily time frame, zoomed out a bit for good broad market forest for the trees perspective about the circumstance in which we currently find ourselves in and where we might be going. Obviously, we're still in a multi-year bull market denoted by these rising and properly aligned longer-term moving averages on the S&P daily chart. Here's the 200-day, the yellow line, since at least October 2011, down at the 1074 lows, if not March 2009, down at the 666 major bottom there, depending on your interpretation. But either way, starting in May of this year, we settled into the zigging and zagging pattern denoted by the light blue lines. In early October, we actually had a chance to break down from it, but as often happens in the market, from failed moves in one direction often come aggressive moves in the other direction. And if you get squeezed and you don't have the discipline to get away from that reversal, it can be quite painful. But either way, we wound up breaking up and out of the rising channel back in mid-October. We successfully held the retest of the breakout point in early November, 1746. And then, again, we were always talking through these things as they played out. The new wrinkle of late, and this is something we've been talking about over the weekend in my weekly strategy session service and inside our 12601 trading service as well, we settled into this pretty textbook bearish rising wedge. You can see visually the difference between a rising channel here and then a rising wedge, and we actually broke down from it early last week. But this has been, you have to realize, we're in 2013, where it's been a very resilient, strong bull market, of course, and it's never going to be that easy for bears, at least initially. So just as quickly as we kind of broke down from the wedge, and it did project a move back inside the channel at 1736 or so, if you go by the technicals, the projected price move. Again, bulls initially defended. Remember the strong rally last Friday, Monday, again, another pop there. The 20-day moving average, which is the orange line. However, and this is something we talked about yesterday, you did want to keep that open mind, that just because this is the year 2013 and bulls are resilient, doesn't mean you just want to cavalierly dismiss the bearish rising wedge thesis because it hadn't been negated. And we kind of saw that today. You really wanted to trade against two levels, and you still do, in my opinion. The 20-day moving average is your first line of defense. That if we lost that, and we did lose it today, we closed 6 points below it. You can see we tried to bounce up from it, but usually you want to see more of an aggressive bounce with follow-through. We gave up even last Friday's gains today. So that's the first level against which you want to trade longs. And I think the second level is the main one, the big kahuna one, 1746. That if we lose that, my belief is that we're going to go ahead and break the channel all the way to the downside. We will undershoot the price target. I think this will end up being, this will prove to have been a big bull trap. But again, you have to take things one step at a time. For example, when you get gifts in the market like this morning, I sold out of my win long, the final piece of it, inside 12601, because the market was red. Many stocks were quite weak. But then, when the market gives you a gift like win, opening up green and kind of gapping up, I think you take it in this particular spot. And the main reason for I'm mentioning win, not just talk about a win. Believe me, I have plenty of losses too, and the idea is to always keep those losses small. It's not about wins and losses. Here's what it's about. It's about recognizing the nature of the market. We talked about this yesterday. The idea was to recognize we were in a market environment where breakout players really needed to temper their expectations. That's what I'm getting at here. Not getting at wins and losses. I'm getting at, again, the overall discipline in the market. For example, let's talk about a trade which I had high hopes for, and it didn't necessarily go my way. I got out for basically scratch. I had previously had a nice win on it. I think this move right here, and then my entry is around right around here. The original entry was around 354. I added to it yesterday, and today Netflix, one of the four horsemen, right when it hit 370, I put out a chart on StockTwits. I really felt like if it could hold over 370, shorts would be on the run. That didn't happen. I actually ended up selling out of Netflix. Maybe I got shaken out, but my point is, again, I think breakout players really needed to temper their expectations with the overall market environment, the bearish rising wedge, and, of course, the Russell 2000. I mean, that really, bearish rising wedge on the S&P aside, that action in the Russell 2000, basically this entire week, uh, even if you want to get cute, going back to late November, I should say, that action has been very concerning in my opinion. Now we take a look at the Russell here. This major support trend line going back to late August, early September. This light blue line, that's going to be a big kahuna kind of support level to hold for bulls. But for now, look, obviously the Russell, this move right here, the first week in December, we'll call it late November, after Thanksgiving, through first week in actually, excuse me, up until the last week in November. This move right here, it's been negated. So that's something to consider there. The Russell might be kind of presaging a bigger bull trap. That's something to keep an open mind about. But we've been talking about, let's go through all these marquee leaders. Amazon, it's been holding up well, but no trigger yet for another move higher. You don't want to get complacent. Apple, holding up relatively well, found some rejection up at 570, that area. Holding up well, but no secondary entry point. We played this one nicely. Be disciplined. No secondary entry point yet. Google, again, just kind of drifting higher. No damage yet, but not kind of rip-roaring higher each and every single day. Chipotle Mexican Grill still just kind of hanging around. There is risk, in my opinion. This could make a nice short back below 517, 516. If you're looking for a very quick short, maybe I think that's one to have on your radar. There, Priceline.com, and we talked about that. Again, no trigger yet. Let's get into the Four Horsemen. Facebook, good day yesterday. Today, look, it did give back some. Now we'll see if it can hold this 50-day moving average area. That's pretty much, I think, if you're looking to be a bull on Facebook, that's what you want to see. You want to see it base out a couple of days. LinkedIn didn't have such a good day as Facebook, but I guess you could argue sell volume was really nothing to speak of overall. You can see what I'm getting at. Overall, LinkedIn still in this, I would say, corrective structure, falling channel, you might call it. Not in a new bear market. It's just still, broadly speaking, kind of, again, just in a corrective phase. We'll see when that changes. Tesla, again, I think you really want to focus on your triggers. 145, in my opinion, looks to be the nut to crack to the upside. So that's pretty much your marquee names in the tape. Then you have a name like Twitter. Again, it's an IPO name. It did overshoot its IPO high from November 7th. It seems to be getting really popular trade now, and I think that's part and parcel of the fact that momentum became much more narrow in the tape, and therefore momentum traders are going to congregate around the same kinds of names. So just be careful with that. It's tough to be short Twitter. I wouldn't be short Twitter, but again, with technical analysis, if you trade off of charts, usually these IPOs need several months to form their own kind of ebb and flow. So I would be very quick, long and short with any of these IPOs. MasterCard, huge gap up, obviously. Lots of announcements after the bell yesterday. Overall, look, I was very bullish on MasterCard back here. I turned prematurely cautious on it as being a stretch rubber band. Same kind of thing with Visa, dating back to May of this year, or right around there. But still, you take a look at this chart, in my opinion, these names, MasterCard, Visa, they're still abnormally stretched, steep. Maybe that's a Bernanke bubble. Maybe that's a secular growth story. I'm not sure what it is, but I just have a tough time committing fresh capital on the long side to any of those kinds of names for anything more than a, very quick flip. I'm talking, 1 to 3 days max. I know those are, again, kind of hot names there. Natty, just a complete beast, natural gas. Look, this is a confirmed double bottom for UMG as long as 1980 holds for UMG on pullbacks. And you have to assume that it's going to cool off soon, just for a couple days. But this is what you want to see off of a major bottom if that's what you're playing for. You don't typically, major bottoms play hard to get. Okay, they're going to do this like natural gas is doing. So now we just, show some discipline. We played it here, UGAS. Now we show some discipline to triple levered long one. Now we look for, again, our next entry point. I think we're probably going to have to be quick if we're going to get it. These things are tough. It's like bagging the elephant. These things are very, very tough if this is the real deal kind of bottom. And again, 1980 is your dividing line for Natty. As long as it's above there, I'm operating under, I'm assuming natural gas has put in a meaningful bottom with plenty of doubters and skeptics. USO crude bounce off that 33 level we looked at from the summer lows. It's kind of churning at the 50-day moving average, so keep an eye on that one. 126, remember, Blind Squirrel noted, this is fascinating stuff to me. China became, all of a sudden, got really chic as a bullish play. Inverse head and shoulders bottom, you could argue. But our member, Blind Squirrel, that's the handle he uses in the room, and I think on Twitter too. This was an excellent observation by Blind Squirrel that the China ETF, it gapped higher in mid to late November, kind of churned around here, and then gap lower. When you see gaps on either side of this kind of sloppy price action, this is like an island of trap longs. And again, look, it's just interesting to me that it's back below the quote unquote neckline of this inverse head and shoulders bottom. So at a minimum, China I think it's on the bulls now to reassert themselves. They have to kind of re-raise what happened today. It's a little bit sloppy there. APC, my friend Walk Slow on Twitter, Walk Slow 4OT on Twitter, pointed this one out. Just getting obliterated. You could see. I'm not sure if there's news there. Let me look for any kind of logical support. I mean, it is coming into some prior price memory from this spring of this year. But again, there was some damage under the surface today. Salesforce.com, not just on the Russell and the indices. Some of these, again, if you want to be aggressive, that could be a quick short play. Dan, had a chance to break higher, charted it back here. I thought it was going to look foolish. It was going to break higher. Now it could be breaking much lower. What else do we have? Shutterstock still basing along here. Maybe it's a long idea. If it could finally get above 76 and hold, that's one to watch. INSM, that's what I mean. That's not what you want to see. Some of these names, let me follow up on some of these names. LifeLock, that's no trigger, no trade. That's not what you want to see. Burger King, again, this is not the action you want to see. The stocks setting up. Riverbed, it needs to get above 1775 to have a chance. So, guys, we're not looking at kind of a proliferation of high probability setups. YNDX could have run with the internet names. Instead, got smoked. That's a nasty candle today on heavy sell volume. Again, no trigger, no trade. Sufun, or whatever you pronounce this. Again, this isn't a broken chart yet, but there's no trigger for your trade. So I think you just kind of let it be until you get a better setup there. So, look, overall, I'm not really looking to kind of push the envelope on the long side. I'm not looking to really, frankly, initiate or push in any new longs unless they present themselves and the market firms up. Ford, I'm still short this one. We'll see if we could finally lose the 150-day moving average. I know shorts are very tough in a bull market. So, but at the same time, remember, there are not a lot of high probability longs. I mean, Zing is an interesting name. I would like it above 414, 415. I think that's still one to watch. Some of these internet names and social names you could see broke out, check back. Now it just needs to resume higher. ANR and some of the coal names, they have not negated this recent move, but as usual, they're giving you headaches or being sloppy. Walter not quite as strong as ANR. So, okay, overall, guys, I think that's pretty much the tape that we're looking at here. I mean, let me check in on Baidu and some of these recent. Yeah, I mean, look, Baidu has not negated this breakout, but you could see some give back today, and it's not as tight as not as quite as healthy as you'd like to have seen, let's say, maybe in earlier this year. So I think, once again, my point is not to call the top to the market. It's just to alert you to the idea NASDAQ, you just have to temper your expectations, I think, as a breakout player in this tape. If you're looking to buy support, just keep in mind, it seems almost ubiquitous that everyone's looking for that kind of Santa Claus rally here. Maybe what catches most traders off guard is kind of a bloody December. But my biggest position right now is cash. And until I see better setups emerge, it's probably going to stay that way.